Thank you for joining iMeet. When you hear the tone, you will be the 28th person to join the meeting. This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. Sorry we haven't had a webinar here the last couple of weeks, but when the markets closed on Monday, I basically have already pretty much summarized what we have to say in the Friday market letter that comes out after the close. So there's not really too much for us to discuss on Tuesday, the days when the markets closed on Monday. So that, unfortunately, that means that next week we won't have one either, but we will be back in 2 weeks. But like I say, we've got a lot to talk about today. And what I want to try to do today is kind of dive in. Let's just look at some of the different indexes that we always look at, support, resistance, maybe some Fibonacci retracement levels. And then we're going to talk about the post-election rally and where there's still the areas that we still may want to put some money into, and also take a look at some of the sectors that have maybe gone a little bit too far, too fast, and we're starting to see some negative divergence that means you want to go to the sidelines until maybe we get a little bit of a pullback. First off, the CTI is at a -6. I think it stays at -6 or maybe -10 this week. Also, the market posture went to bearish as of December 23rd, when the Dow Jones closed at 19,933. So a lot of spinning the wheels. We've been up a little bit, been down a little bit. If you do the triple leveraged ETFs, as of this morning, I think you're off about 1%. You know, consider we made 70% to the upside last year. I don't think we're too worried a little bit like that. You know, the market's having a little bit of a struggle in here with the Dow trying to break through 20K, and we also just a lot of the different sectors that we look at today. You'll see that there's a big resistance that we're coming up into, and as far like what I wrote last night basically was that we kind of have a market that's priced for perfection, and as we go into the inauguration, I think we're going to have a lot of investors reconsider just how fast the new administration can push through some of their policies, with the deregulation and how rates are going to be affected. And I think that due to that, maybe we'll get a little bit of I heard somebody talking about it, that we're on a sugar high with the market right now, and that usually doesn't end too well. But we'll have to see, because there's not a lot of signs that I see yet that we're just ready to roll over and you got suckered into a rally. So first thing we want to look at today, and also I want to apologize. We have some different charts up. These are from the site stockcharts.com. John Murphy, who is one of the leading technicians in the country, he has his own website where he just does all charting for you. And I'm going to use that because we're in the process, probably over the next 2 or 3 weeks, of rolling out our new updated website. It's been a long time. They've been working on it for about a year and a half. Also, our charts will be web-based, which means you won't have to go through all that Java stuff anymore. We have a lot more indicators. And but today, until we get that going here, they kind of flipped on us a little bit. We're going to use John Murphy's stock charts here, and we'll go over that kind of stuff. So first off, here's the Dow Jones. As you can see, it's been up here. We had this big rally off of here. The Dow's has ran about 10% off that level. But pretty much since early December, we've been kind of going sideways. A little bit of a pullback down here. What I want you to see, you're seeing a lot of the momentum indicators starting to slow down. Here's the RSI, no longer overbought, but heading down towards that 50 level. MACD, which is kind of a short-term trend indicator, shows momentum is actually has slowed. If this goes down a little bit more, be even more bearish. You saw the stochastic package over here. And for today, I'm using the 14.3 rather than the 33 that I usually use. You can see that on this last little bump up, the stochastics didn't quite get up, where they needed to be. They're not. The market's no longer overbought in here, which maybe explains some of today's action. But I want you to look at a couple of things that we talk about occasionally. This pink line right here, the P in here, is called a pivot point. And the pivot point is what traders look at to determine whether they want to be long or short the market. Okay, when you see the stock or the index or something pull back below this pivot point, generally that you'll get a lot of shorting coming in here, and you might see it come down to the next level of support or go to resistance. And these resistance and support levels are based on the intraday ranges of the high and low, the whole range of a previous day in the market. You can subtract or add it on to the closing prices to come up with these levels. And they're used by traders on the floor and also in Chicago to see where they want to get long or short the market. And for right now, the last week or two, I've been saying that I think support down for the Dow Jones would be around 19.6. The actual pivot point is about 19.629. It might go up a little bit tomorrow. But at that point, you're going to have, you can see it go into here, and the secondary support is going to be down here where the support level done. They'd say it's 19.248. I was looking at about 19.300. That also would represent a Fibonacci retracement of about 38.2% of this whole move from here up to the December high. So that also represents almost exactly where the 50-day moving average. So if things begin to get a little bit dicey in here, we start to go down below that 19.6 area, I would keep my eye on this level around the 19.250, 19.3 to see if that's where we can hold and maybe go a little bit sideways and build from there. But the indicators are somewhat, they're nothing too scary on them. I don't see a lot of real negative divergence. I just see a little bit of a minor pullback and slowing of momentum. And until we see these things really start to fall apart, I think you're okay like right now. And even though the CTI is bearish, I do think we will come down in here over the next couple of weeks. I don't see any reason just to sell out right now. Okay, the S&P 500. This is just a 6-month chart. Again, the pivot point down here, it sold off. It's amazing how these things work this way. It came down, found support at about 22.38, which was the pivot point before, held that support level and bounced back up here into support up here around 22.80 is where the support is. That's right about where this rally today is stalling out also. And again, if we get some selling on this thing, the 50-day moving average is down here around 22.10. So I would look at anywhere from about 19.95 or 22.95 to about 22.10 for any kind of a pullback where you might be ready to pull the trigger to go back in. Of course, we want to make sure that holds. If that comes down here and breaks those support levels, then we'll have to take it. But again, you have a little bit of negative divergence down here in the 14-day RSI, a little bit of negative divergence, and actually a sell signal on the stochastics. CCI is commodity channel index is also beginning to show weakness, but not until that crosses below zero are you going to be worried. Now back here when it pulled back, it immediately turned around the next day. So that sell signal there was aborted. So that's what we'll look at next. We're looking at how much accumulation and distribution is going on. This is the NYSE advanced decline line, which is on the Market Edge homepage. If you click on Market at a Glance, you'll get this. So what you see in here, you're still seeing the AD line for NYSE making higher highs and higher lows, but you do have a little bit of sell-off here. Now this is normally a leading indicator. You'll always see this thing peak out ahead of the market. And it's funny because the last 2 days when the NASDAQ was making a new high and the S&P made a new high on Friday, you actually had more declining issues than you did advancing issues. So that's a little bit of a red flag. Over here you see the NASDAQ not quite as strong. You see we're punching out new highs in the NASDAQ going straight up through here. And let me grab my pointer over here. And you're not really, you're not getting confirmation of those new highs here. Today there's more advanced issues and decliners. We'll have to see how the day finishes too. That's we're at the point right now where you want to see these morning rallies are going to hold or not. Now if you start to see this thing in another week or two start to break below this, that's going to be a big red flag. That means that whatever is holding the market up, especially the NASDAQ, is going to be a limited number of stocks. So we'll keep an eye on that over the next week or two to make sure that it can stay steady. Well, because if it begins to fall lower, that would probably indicate that we may be going, that we may get a little bit of a pullback. The next one over here off the market at a glance is the NYSE new highs, new lows. Generally, when you have a good, strong, broad participating market, you want to see this, the blue line up here around 200, 250. In the last couple of days, we're under 100. Look, today we're still only, I think we're less than 100 today too. Yeah, right now we've only got 67 stocks making a new high in the New York. You only have 74 on the Nasdaq, and the Nasdaq's up over 0.5%. So participation in this last part of this rally, where it's kind of stalled out, is getting narrower and narrower. That's a red flag for you that the traders and investors aren't just buying anything; they're being a little bit more selective. And we're seeing we've seen some rotation now the last couple of days, and some of the gold mining things are getting a little bit of a bounce. So you want to kind of watch this thing here, and also here's the Nasdaq. Again, when we started to break out after this post-election, boy, everything was jumping up, and now we're just kind of seeing, like what I say, lower lows and lower highs. So this is dwindling down a little bit. You want to see this, if we're going to keep going, back itself up here around the 200 level on the Nasdaq. So right now, this is a little bit of a warning to us. Okay. Next thing I want to look at real quick, this is the Nasdaq, which again is we're up about 0.5% today, powering up to another new high. We're at 55.60. Okay, the pivot line over here, which was tested back here a couple weeks ago, is at, the pivot line is right at 53.37. So that's where you want to see this thing, which is a good ways away. I think you get about 2% pullback before you're going to start running into this pivot line again. But right around that area also, you have the 50-day moving average at 53.50. So if we come down and we test that, and it kind of gets a little sketchy, that would be a place where you're going to see traders begin to lighten up on their positions, maybe get short. However, you're not having any red flags in the indicators. There's the 14-day. You'd like to see this I'd like to see this thing punch out over the next day or two above 70, indicating that we're confirming the move higher. The stochastics are still showing we're good. The CCI is also overbought but positive. And again, I think two things can happen when you have an index leading the market like this. Either either Nasdaq is going to stay this strong behind the strength in the semiconductors and the biotechs, and pull the rest of the indexes up, or the weakness that was in the transports and the Russell 2000 the last week or so is going to weigh on the Nasdaq and pull it down. Now, one thing that I do like about the move, especially with the Nasdaq, is the biotechs had been underperforming a lot. Now, over the last five trading days, the iShares Nasdaq Biotech ETF is up about 7.5%. It's up a little bit today, not overwhelmingly so, but today I think it's a little bit more with the semiconductors, because they're also up about 0.5%. But again, the indicators down here aren't giving any real flags to us. But if we get a little bit of a pullback to this area here, you want to make sure we stay above the lows back here in December. Now, two more charts that we talk about a lot, and this was actually close to giving a red flag. All summer long, all through here, we kept saying, boy, if we're going to break out the sort of new leg here going into the election, the transports have to break through this level up here to get above 8,100, 8,200, and it would rise up here with the market and back right off, jump up here again, back right off. We finally got that breakout right over here at the election. It outperformed going up. Surprisingly, the transports were actually the leading index, and they were up 21% from this level over here to September lows, from there to there, 21%. So they've actually gone a little too far, too high, but they led the way up from this thing. They outperformed, and they also, in this case, have pulled back the most. Now, so far, this 9,000 area is holding, but you see we are trading underneath the pivot level. Okay, the pivot level on this thing is at 91.70. Today, after being down like 3 or 4 days here, the transports are up 1.16%, but they're still below the pivot level. They're 91.27, so we're right over in here today. That's where we're at. So you want to see this thing. What you see the indicators here are a little bit bearish. The RSI is holding above 50. You want to keep this above 40 when you're looking for a trend. If this thing breaks below 40, not only does it show overbought and oversold, but if you're going to stay in a bullish trend, you want the 14-day RSI to stay above 40 and trade between 40 and say 80. If it goes below 40 and then on the next rally it falls short and only gets up to about 60, low 60s, that means that you're switching over to a bearish pattern. So as long as this 14-day stays above 40 here, you're okay. You're oversold on the stochastics just about. You're down here about 30. If you can get this thing down, it doesn't look like it's going to get there unless we roll over again. So you were oversold a little bit, but not too bad. This will probably jump up here to 40 or so after today. You want to keep an eye on that 9,000. It came down here 1, 2, 3, 4, 5, about 6 days in a row. Got close to 90-20. Didn't break through, and that's good for that. But as long as we're trading, this red flag is still up on this thing. As long as we're trading below 90-70. So keep an eye on that. A break below 9,000, and that's a real red flag that that maybe since the transports let us up, they may be leading the way down. The last index we're going to look at real quickly here is the Russell 2000. Again, it led outperformed on the way up. We were up about 15% from this level up there, and then we stalled out up here again, going sideways, bumping up against resistance up here. We are above the pivot level, and you can see how close it comes to that, which is around 1302. Comes down to there, it seems to catch itself and goes on up. However, if we do break below that, the 50 days comes into play, some here around 1310, 1317, and if it breaks below that 1350 area here, again, that would be another red flag. If you have the Dow, the transports go below 9 and this thing go below 1350, I would be very cautious and start thinking about what do I want to do over the short term to maybe lock in some profits, because you've had a heck of a rally in through here. But these still look a little weak. You still see the deterioration in these in the indicators for the Russell 2000. So to wrap it up, it looks like I wrote last night. I think that we are priced for perfection, and quite frankly, we just don't know how fast Trump can pass his get past the deregulation or the lower taxes or some of the measures that he's looking at. And so is it a little bit of a sugar high? Yeah, but the market's has been going sideways actually now for about a month. In fact, I wrote last night in the daily comment that yesterday's close in the transports had wiped out all of the December moves. So we want to keep an eye on that. And then right now we're going to take a couple of minutes just to quickly look at the sectors to see where you want to stay away from at this stage and where you may want to have some money ready to go into. It's kind of funny. I laughed yesterday. I read an article by Jeffrey Sott from Raymond James, and he was talking about a new acronym that Tom Leofunstrat came up with. And we spent so much time last year and earlier this year talking about the FANG stocks and even the TANG stocks. And Jeff thinks it's time that we buy the CRAP stocks. That's CRAP, which is which kind of stands for Computers, Resources, American Banks, and Phone Carriers like Verizon and T-Mobile. And what he wants to look at over there is just to see how fast that's going to go. But these are the sectors that he thinks will be affected most by Trump's policy, no matter how fast or slow he gets things going. So what we're going to look at right now is look at all the different sectors. So far, almost over the last 90 days, and that's going back just before the election, only two of the sectors are in the red. That's the healthcare and consumer staples, which with the move in the healthcare and biotechs recently, that's where I think you're seeing the NASDAQ really kicking it into another notch over here, because they had underperformed. They're just playing a little bit of catch-up ball. So first up, we're going to look at is the financial sector. A lot of stuff going on in here. What this includes is the banks, brokerage firms, insurance companies, the big money centers, the Goldman Sachs, the Bank of America. If you've been in these stocks, you've benefited from all this. They tend to benefit from a higher dollar, higher interest rates, less regulation. All three of those are part of the Trump platform. So Is it extended? Yeah. In fact, we've been going sideways here now for almost a month, but we're still above the pivot level, which in this case is 23.15, I believe. But if you're long the banks, I don't see why you'd want to really sell them. You may want to sell some covered calls in here. The market pulls back a little bit. I would use that as an excuse to add to these positions because I think these will, we'll still have room to move. The banks have outperformed for 4 or 5 years, and in fact, when the market was going up here the last couple of years, a lot of people thought that unless the banks, we're not going to really break out until the banks participate. In this rally in here, we saw we were up 20% in that sector, which is 2 years worth of movement. Now, one thing I would be careful on the financial sector, that is, I would tend to limit my exposure to banks or companies that have a lot of exposure to mortgages. The reason being, if the rates start to pick up a little faster than what they expect, those companies we'll see a drop off in the in more new home buying and that kind of thing. So I would tend to steer away from that. But momentum is slow in this group. We're not getting near. I told you about the RSI. You want to keep this thing above 40. We're still at 50. This thing's been going sideways, and this thing's still pumping in here around 58.60. So not worried about these. I wouldn't be putting new money to work on the banks right now and insurance companies. To come down here by the 50-day, I would buy that. I would probably add it if we break through there on a deeper market sell-off. That would be the first group I would put some money into. So if you own them up here, you may want to consider selling some covered calls so you can lower your price structure a little bit. Unless you've got something pretty volatile, I don't think I'd buy puts. I think I'd be more inclined to maybe take a little bit of profit and add to it if it comes back. But again, if you don't want to sell Bank of America at 22.50 and look to buy it back at 20.50. That's pretty nimble trading. But this is probably going forward going to be one of the leaders still going forward the year to date. The second best performing sector since the election was the industrial sector. And again, you see this stall from after we had a kind of a blow off up here, and then we've kind of traded sideways. We're right on that pivot line. Again, that's where it keeps finding support. The XLI, you're looking at 62, 64 or so on that level for the pivot. If it falls below that, things might get a little dicey. But this group, is also running up on the belief that the new administration is going to build out the infrastructure, new roads, bridges, that kind of things, and these big companies will supply a lot of the goods. Also, defense companies, some of the companies that make the fighter planes, that kind of stuff, Boeing, things like that would be good. But as long as you're in the companies that do most of their business in the U.S. with the industrials, I think you're good. You can buy on any sell-off. The red flag on this would be the companies that get a lot of their revenues overseas. They're going to suffer from the stronger dollar, which is we're going to probably reach parity here any day with the euro. And what happens is when these companies do a lot of their sales overseas, when they bring their profits back, the currency exchange can cut off 3, 4, 5% of their profits. And I think going probably over the next couple of weeks, or when they start releasing their fourth quarter earnings, you may see some of these companies begin to say, hey, the dollar's moved up so much. We may have a problem. We may want to trim our estimates because of the stronger dollar. So, but as long as you have even some of the smaller caps that do a lot of business here, and I did a comparison of like John Deere versus Caterpillar. But John Deere actually does most of their business here in the States, and I think they can benefit from from the build out of the structure. However, Caterpillar gets more. I think it's something like 60% of their business is overseas, and the strong dollar also hits your emerging markets, and that's going to slow some of Caterpillar's revenues and sales. So I think if you look at the different companies that may be very similar, go ahead and go with the one that does more of their revenues in the United States. The next one I want to look at, the third best performer is materials. Of course, that's companies that make cement, bricks, again building materials. They ran up. They were up about 9.8% from after the election. Pulled back to the pivot area. They're moving up here. We actually have seen a little bit of buying power going in here over the last couple of days, and they're starting to strengthen again. You see the MACD starting to go positive again, and even the 14-day SR starting to move up a little bit. So I like this group. I think any type of pullback, I still think you want to own this group. I don't see a reason to take any profits right here. You're butting up against resistance up here around 50.31 or so on the XLB. But I think this is an area that you probably want to put new money to, especially on any type of a pullback. Okay, this one here, the fourth best one is the consumer discretionary sector. It's up about 5% since the election, bumped up in the resistance over here. Once, this is twice. Hope if it hits here and starts to pull back again, you'll have a little bit of a double top. But things have been picking up here lately. What I don't like about this group is that there's a little bit of negative divergence. You're almost ready to make a new high, yet you have the RSI is not quite confirming that. And also down here, I added the accumulate like an AD line for this whole sector, and you kind of got a little bit of sideways. Which means I don't see a lot of institutional buying going in over in here. I think last week you had Macy's say that the holiday sales were a little bit soft. You saw Kohl's and Macy's and some of the other ones struggle. They were down about 15-20%. The fact is, if you buy like the retail stores or anything that thing, unless you're buying the specialty stores, I think you're gonna have a little bit of a problem. The kids don't hang out at the mall anymore. They're glued to a computer screen, and I'm not even sure adults go to the mall anymore, but they do go to the specialty stores like the Home Depots and the Ultas, where when they know what they need, they go to that store, and I think you'll be okay on some of those. But again, be very selective on this. I think this sector may underperform going forward. I wouldn't be a real big buyer of this group over the near term. Okay, now we had another one, energy, which has been struggling here since topping out here in very early December. This is one that, I would not be looking to buy unless we get another pullback down here around, if we see crude oil prices maybe fall below $50, that range. Today, it's crude oil is around 51.51. But the problem with I think you want to have exposure to oil stocks, preferably the refiners. But I see a lot of resistance in oil around 52 to 55 level. You have potential. You could get to 60, but over 55 to 60, you're going to start seeing more U.S. rigs come online, and because we can make money over here off oil above 55. OPEC, I think if anything, they want to keep prices around 53, 52, which is very iffy. We're just on the line so that the U.S. Oil companies aren't knocking each other over to get more rigs in production. So, and also I think with Iran, they still want to keep on pumping up, even if they have an agreement. Just the fact that they want to get back to where their production was before. They need the money. So I would say on the oil stocks, so you may sell some covered calls below your prices. You could take some profits if you see a rally in them, and then I would buy back to them if I see the oil trade between $45, $48. That range, I think you add, because you may want to longer term. I think that's an area that you want to go into. Again, you're seeing some weakness and deterioration in those indicators. I'm not going to go too much longer here, but here's the technology sector. This is outperforming over the last couple of days. This is something that you probably want to be buying into if you're looking to buy. This is overbought at this stage, but I think on any type of a pullback, you want to add these positions. All this virtual reality and driverless cars and home devices that manage your heater and all that kind of stuff. They need a lot of chips, NVIDIA, AMD. You want to be in some of the semiconductor stocks if they pull back on any kind of a pullback to the pivot line. You're way above the pivot line at this stage, but again, you're getting stretched here. And like I say, with the sell in the overall market, I think any big surges from here, I would probably lighten up, or at least maybe even buy some puts. If I have something like an NVIDIA, it goes up to like 125 or something like that, and I own it at 50. I think I'd you might just buy some protective puts on there to go out a month or so just to see if the market does come off, you're locking in your profits. Okay, lastly here, I want to look at the healthcare sector, one of the few that's not pushing at a new 52-week high. And because of this run in here, this is helping to push the NASDAQ to all-time records, because you were oversold in that sector. And now you're playing a little bit of catch-up ball. You have resistance right up here, which could be another little bit of a double top if we don't break out of that. But this represents 61.8% of the retracement of this whole move down. This was kind of from the people worried about if Hillary got elected, big pharmaceuticals and biotechs would suffer on pricing wars and that kind of stuff. So if we break through here, you could get a little bit of another breakout. And sometimes when it when it retraces 61.8% of a move down or move up, oftentimes that'll lead to a full retracement of the whole move down. So I think the healthcare actually has some good potential in here. I do like the biotechs in here, especially any type of a pullback. So I would be, I would have some of those on my radar. With the biotechs, we've talked about it before. You want to try to buy a basket of stocks rather than just put it all in one biotech and just hope that that's the one that gets the approval. So anyway, I've gone a little bit too long here. Again, I like to try to keep these things, me talking about 20 minutes, but I've been going for about 35 minutes. So I'm going to wrap this up. I think we have a couple questions, but my charting package isn't working, so I'm not going to be able to go that. But anyway, keep an eye on the S&P 2250 would be if it trades below that, that would be my red flag for the broader market. We talked a little bit about which sectors we would commit new money to, and which ones we'd kind of steer off or start thinking about selling some protective calls or selling some covered calls, that type of thing, to lock in our profits and kind of keep an eye on things. Our CTI is going to probably stay bearish till about the last week of January, first week of February. Again, we're not making any money on this call, losing a little bit on the NASDAQ leverage position. Russell and Dow were making money up until today, I think. So keep an eye on it in here. I think the volatility is going to pick up here over the next week or two, which will give us some triple-digit swings up and down. The Dow, count on it probably hitting this 20K before we do sell off. And again, I will not be here next week, but I will be here on the 24th, which will be very close to when we're looking at the CTI as to whether we're going to flip it or not. So I think that we'll have something good to talk about then. We'll just see how this thing plays out over the next 2 weeks. I wouldn't be anxious to be putting more new money in at this time. Just kind of watch what you have and keep an eye on these pivot levels and support levels that we talked about and pointed out today. And we'll have this thing back up on our webinar on our website probably later on this afternoon. And with that, I'm going to say goodbye. If you have any questions on this, I'll look at them over here after I sign off, and then I'll try to respond back to you. Or you can send an email to me at the doc@marketedge.com. You have a great week, and I will see you guys on the 24th. Thanks for joining me.